Stock Play of the Day is an educational program. Any statements made by Ally Invest employees are not intended to be or should be considered investment advice, a recommendation to buy, sell, or hold a security, or a recommendation to adopt an investment strategy.
Welcome to the stock play of the day. Today's stock is Twitter, symbol TWTR. We'll discuss should we pass or should we play? Welcome to the stock play of the day. My name is Brian Overby. I am the senior options analyst at Ally Invest.
And I'm Lindsay Bell, Chief Investment Strategist at Ally Invest.
Well, Lindsay, we got a couple of big things coming up. First of all, we're right in the heart of earnings, quarterly earnings for most of the companies. And in general, coming up, we have a little thing called an election that's going to be happening. So what do we have going on? What do you see going on in the S&P 500 index this week?
Yeah, we've got some big things to look forward to over the next couple of weeks. The election's only 3 weeks away. Can you believe it? This morning, well, early in the morning, the market was green and now it's red. It gave up the gains. I think really more important than the election right now is the stimulus bill that is, lingering in Congress right now, I guess you could say. Treasury Secretary Mnuchin and Speaker of the House Nancy Pelosi, they spoke all weekend long. Nancy Pelosi seemed to be optimistic about getting a deal done in the next 48 hours so that we can get something done before the election. But that's fizzled, I think, over the last couple hours. And so investors are feeling a little less upbeat, at least at this point in time. But it's been on and off for the last couple weeks. And there's a lot of uncertainty about what's going to happen with stimulus. So we're going to go ahead and keep our eye on that. I think it's going to continue to be the key driver going forward because we really do need that stimulus for the small businesses and the individuals that are continuing to struggle through the coronavirus pandemic. We also are seeing too, probably helping to cement that more dour tone today, is that coronavirus cases are peaking, or not peaking, they're spiking again. They crossed 40 million across the globe over the weekend too. So that's a very sobering number there, Brian. As you see in the chart here, the S&P 500, we're still struggling to regain the ground that we lost after that September 2nd new all-time high. We're still just over 2 percentage points below that. You've got this red line drawn on here that we are staying below. I'll let you explain that after I finish my spiel for what's going on in the market this morning. The other two things I think driving the market are China data came out overnight. So GDP growth of 4.9%, positive 4.9% for their third quarter was probably the low end of most analyst estimates, but we did see some of the retail data and industrial production data was better than expected. So I think the market taking a positive reaction, or is having a little bit of a positive reaction to that. But these other things are outweighing that. And then the other positive piece of news too, so we've got some negatives, pluses and minuses today in the market, is homebuilder sentiment reaching a new all-time high, second month in a row above 80 ever. And the outlook seems positive for that as well. But again, not enough to keep the market in the green today. Again, we'll look forward to hearing from earnings estimates or earnings results from many companies. I think about 15% of the S&P 500 is going to report this week. Last week was a good week. We kicked off the third quarter earnings reporting season. Numbers continue to move higher, although we're still expecting a 20% decline year over year on an earnings growth basis for the S&P 500, which is very weak. You have to go back to 2009 to see numbers like that. But the numbers are moving in the right direction, and we know the market is a forward-looking mechanism. So while volatility is likely to remain stubbornly high, we see it going up this morning, Brian. The VIX, I think, above 28 last I looked, is reacting to some of this stimulus and COVID news that we're getting. And there's just a lot of question marks that need to be answered over the next several weeks. A lot of which I just talked about here. So I wouldn't expect volatility or the VIX to come down anytime soon. I don't know. What do you? I-
All right, you cut out there just for a second, but are you talking about the VIX right now? I think that's where we
Yeah.
last.
What do you make of the VIX at the
Okay, well, I'm going to bring up my little watch list that I keep on the VIX index, and then we do see that the VIX right now is at 28.14. And well, actually, in this day and age, it's hard to say exactly what the VIX is going to do relative to the market, because we've seen a lot of up days in the VIX or up days in the market, and still have the VIX index actually follow the S&P higher. In this case, we have the SPX down and we have the VIX index up. Now, that makes a little bit more sense compared to what it used to do in the VIX index. It's a mean reverting index overall. So the other little nuance that we're having is that if we look at the October and we look at the November and we go all the way out to January and December, we're actually staying pretty stagnant as far as what the market expects volatility to do in the future. Now, surprisingly, the November future contract has came off a little bit. It's a little bit of a hiccup. The last couple of stock plays of the day, we saw the November future contract be up over 30%, meaning that the marketplace is expecting more volatility going into the election. It's still stubbornly high. There's still a lot of nervousness in the marketplace. And I think the market right now is just really trying to figure everything out. Now, is this because they think if the Democrats would win, we might get a little bit more stimulus, and that might calm the markets a little bit? But I don't know if I could go that far, because it's not that big of a drop off in the VIX index. What would make raise my attention or make me take notice would be if we could see that VIX index get down below 25 and actually start creeping down towards that 20 level. In other words, people would be feeling a little bit more less nervous about the actual marketplace and what's going to happen next. So the fact that we just have the VIX indexes, the futures going all the way out till January of next year, still anticipating implied volatilities in the VIX over 28%, that is a sign of that nervousness in the marketplace. All right. So we're going to get to, we're talking about earnings. Twitter has earnings coming out. It's going to be on the 29th. After the market close. What do we see in Twitter going into earnings? And I'll pull up a chart for you here, Lindsay.
Yeah, Twitter's talking about volatility. This is certainly one of those volatile stocks. But before I dig into that, I just want to remind our viewers that we are going to take your questions live at the end of the show. So be sure to type in anything that's on your mind on the right in the chat box on the right-hand side of the screen, and we'll get to as many questions as we can at the end. But let's take a look at this Twitter stock. It's one that we haven't talked about in the past, but it's a pretty phenomenal looking chart. Just looking at that, right, Brian? I mean, this has been one of the winners throughout the past year, and actually on a year-to-date basis, it's up 43%. So, I mean, if you were lucky enough to time the bottom in this one back in March, you're sitting pretty right now, which is kind of interesting. I took a deeper look at the chart and some of the fundamentals this morning when we decided to dig into this one. And these guys reported second quarter earnings results on July 23rd. They missed sales and earnings expectations. And yeah, the stock dipped that day, but from then on, it was just a straight chug higher. The stock is actually up 18% since that July 23rd last report. So they're going to report again on October 29th. What I think got investors pretty pumped up about the stock was that even though they missed the top and bottom line, what they did report was that monetizable daily active users grew 34%, the most ever in the history of the company. So that was a big deal for them. And also ad revenue is a key component of that top line sales growth. While it was down 22% in the quarter, that was an improvement from what they had reported in March, in the month of March, which was the depth of the crisis, not only for the pandemic, but also from a revenue perspective for them. So that was an improvement. And that improvement continued through the course of the quarter. Of course, there was a bit of a hiccup when companies decided to no longer post on social media during that period where we were going through significant civil unrest. But companies have since then come back in, and I think investors are getting a little bit excited potentially about the upcoming release because they expect. I think when I think about what investors are expecting and what they need to see on that October 29th report is they need to see, I think, a continuation of those two things, that the monetizable daily active users is continuing to grow, hopefully at a similar rate that we saw last quarter, but then also that ad revenue is continuing to improve. So declines getting worse or maybe even turning positive. I don't know, that might be a little too optimistic. But I think we need to see something that's just better than what the last quarter was. And interestingly, over the last week or so there, you see on the right-hand side of the chart that you've seen the stock come in a little bit. And that's despite Deutsche Bank upgrading stock last Monday to a buy from a hold. They talked about their monetization potential in the future, especially as we get into 2021. And ad spending improves. This has been a year for reduced ad spending by a lot of companies as they cut costs. So as we get past the pandemic, the expectation is that ad spending will increase. They also, are looking for live events to start to return at a more rampant pace next year. That will also benefit these guys. So that's why Deutsche Bank's got more bullish last week. But it seems like the stock is kind of trading sideways as we get into earnings, which could be a positive for the report. But from a fundamental perspective, those are the two things that I would be looking at. Again, monetizable daily active user and ad revenue growth will be the keys in the quarterly reporting period. The only other point I wanted to make, Brian, is I took a look at these guys because Twitter is like, people, you kind of forget about the fundamentals. A lot of time you see it in the news because of the feud that they have with Donald Trump, or more recently they were pulled an article about the Vice President Biden and his son and their relationship with the Ukraine. They also had an outage last week, so it's not always usually the most positive light that you see them being reported in the news. But interestingly, when you think of Twitter, you think of like a Facebook and a Google, because the biggest risk to these guys really is censorship, them putting censorship on their user, but then also privacy. And we know that's a hot topic for government officials, both here and overseas. But Twitter has really not had to deal with the blow of it like Facebook and Google has. Facebook or Twitter, like I said, up 43% on a year-to-date basis. Facebook's up 27% and Google's up only 15%. So, I don't know if this is just shiny new kid on the block and investors still like it better, but that's kind of the way I'm seeing it. But I don't know if you wanted to dig into any of these trend lines that you're seeing in the stock, Brian, before you get into your trade.
Yeah, I did want to kind of highlight the chart. Now, because of everything that you said regarding Twitter, we're going to take a conservative but speculative approach going into earnings. And you did highlight, it looks like the 20-day moving average is helping the stock out a little bit, but there are times where it broke through and it didn't necessarily hold. But obviously, it's a level that we like to look at. Now, we're going into earnings, and it's going to be on the 29th, just a few days away. Now, so with that said, we're going to try to take advantage of this volatile stock movement. Like, we see the highs and the lows and the swings in the market. And the fact that the VIX index has been high, up around 28%, has brought all the volatility levels a little bit higher. So when this happens going into earnings, we're going to sell option contract that expires before earnings, and we're going to buy an option contract that expires after earnings. Why can we do this? Because vols are high, just in general. So selling a near-term option contract, you actually get paid for it. And I've talked about this on a couple of my podcasts and a couple other shows in general, because it is earnings season. And this is an interesting way to approach and speculate on a stock like Twitter, where who knows where it might go after earnings. So we want to position ourselves to either be long or short, whichever your perspective is on the underlying. I'm going to look at a long trade. We're going to flip a coin only because we're just here to learn on the stock play of the day. So talking about calls is a little bit easier than talking about puts, but you can swap the scenario if you want to, or maybe even on a paper trading basis, look at the trade in both directions and just see, well, if the underlying or if the news is good after earnings, well, this is what the diagonal call spread would have done. And if the news is bad after earnings, well, this is what the diagonal put spread would have done. Okay, so inside the options playbook, here's what a diagonal spread with calls is. And part of the reason why we're doing a diagonal, that just means that we are going to be using different expirations, but also different strikes. If we were doing a calendar spread, they would be the same strike. So we're adding a level of complexity that makes it a little bit harder to understand overall. But I'm going to show you why. Because when I went and I looked at our chains inside the Ally Invest option trading platform, let me move this over here a little bit. Okay, we see that the underlying stock is now down about a quarter since the open. And the expiration dates that we want to deal with is we're looking at the October 23rd expiration. It's got 4 days, all day, the rest of the day today, all the way out till Friday before that expires. I would have probably liked to look at this trade last Friday, actually. That's when I would have considered it, but we taped stock play of the days on Monday. So we're going to talk about it on Monday. The October 30th expiration would contain that earnings. They're announcing after the close on the 29th. That would be a Thursday. You have all day Friday to trade this one option contract. So if I look at the strike prices in the near-term option contract, I see that we have a 47 strike. But if I scroll down to the October 30th, there is no 47 strike. And it just is what it is in the options world. So we're going to do it as a diagonal. And I don't mind that trade because if I'm selling this option contract, we're selling still 47% implied volatility. Lindsay even highlighted on the chart that the stock is, the last few days, it's really been stagnant, it hasn't really moved. So we hope that that is the case going into earnings over the next 4 days, Tuesday through Friday, that the stock just kind of hangs in this little area. And we can bring in 38 cents on the bid for just selling this option contract, saying that we don't think the market's going to get up to 47, a point and a half away. Then we're going to buy the option contract that will live past the earnings date. Now it's going to be more expensive. We see it's trading at 82% implied volatility, but that makes sense. There's a known event that is going to occur on that specific date, and that will usually increase volatility in the option contracts. So it's $1.80 by $1.83, but we're trying to cut that cost down by about 40 cents here by selling this 47 strike call option. So if we do this trade, we want the stock to stay below 47 going into the this week, and then we don't mind if it increases going into that earnings, because we're going to be long one call option. So by doing this trade, instead of paying $1.82 to just buy the call option, we're going to be doing this entire trade for a net debit of $1.43 if we can fill at that midpoint. That means our debit risk here is $143. Now, here's where the level of complexity kind of hurts us a little bit. We're selling the 47 and we're buying the 47.50. So there's 50 cents worth of risk, additional risk, because the sell price for the stock would be 47 if we were assigned, and the buy price would be 47.50. So our total risk would be the net debit paid, $1.44, plus that 50 cents, or $1.94 on this trade. But it's still limited and known risk. We're not really paying up for the option contract because we are doing the diagonal spread. We aren't going to go crazy on this trade because it's a speculative trade. And these are all the aspects. If you're going to speculate going into earnings, this is one way to do it in a volatile marketplace. All right, so I'm going to officially make this the paper trade, and then I'm going to talk a little bit about Delta. So let me click the trade button, and I'm going to put it in the right rail. And we'll try, we got good markets in Twitter. So we're going to try to fill that at the midpoint. In other words, the width between the bid-ask spread, even on a net basis on the spread, is still fairly tight. There's not a huge difference. We're talking 143 on the bid versus 146 on the ask. We're going to buy to open the October 30th expiration 47.50 strike. We're going to sell to open the October 23rd expiration 47 strike. Net debit, we'll call it 144. And that means we're going to have to pay $144 plus commissions to put on this trade. But remember, we have that 50-cent difference between the strikes. So that's additional risk that could hurt us if our forecast is incorrect in the short term on this trade. Now, since we got the official paper trade out of the way, I want to talk a little bit about Delta. Now, I don't mind that they are different strikes. And granted, if there was a 47 strike, we'd probably be looking at the actual calendar trade as opposed to the diagonal trade. But with that said, one of the things to note is that we still have more delta on our longer term option than we do on our shorter term option. And that means a lot to me, because that means if this underlying stock does run, basically it's at 45.55, so we're talking about 1.5 points all the way up to 47, I still should be profitable on that trade. So in the short term, if the stock does come up to 47 before this Friday's expiration on the 23rd, I should have a profitable trade and I would just get out of it. I don't want that risk of that shorter term option contract going in the money and working against me hard. So my concept would be that if it does come up to 47, I should have a profitable trade to begin with, and I'm not going to take that risk of that earnings report. I'll take whatever profit I can get, and I just get out of the trade. Now, if the market does go down, that's our biggest risk, right? We put this trade on and the market goes down 5 or 6 points. Then we have a limited and known risk right now. We'd lose our net debit paid, which is basically $1.50. $1.44, I think, is where our price was at. So $144. But take this concept in that this is an all or nothing type trade, that we're going to put this trade on and we could lose that net debit if the underlying goes down and it really works hard against us. But we're just speculating on earnings. Who knows what could happen with Twitter after earnings going into this election, considering everything that Twitter has as far as the political spectrum. Anything could happen going into this election at their earnings event on the 29th. All right, a little bit long-winded, but this is a little bit more advanced strategy. And if you'd like to learn more about it, I'm going to highlight, please go to the Diagonal Spread with Calls. And you can read up a little bit about the strategy overall and look at the option guys tips in general. All right, Lindsay, I'm assuming we have some questions. Are there any out there?
Yeah, and so just a reminder to the viewers that you can find that Diagonal Spread with Calls explanation in the optionsplaybook.com. So check that out. As a reminder, we got a couple questions in the queue here in the chat box. We're going to try to get through them, but keep typing them in. We got a little bit of time here to take them today. So first up, Brian, is Wayne. He's looking at Twitter, so you might want to pull up the chart again. And he's asking, how do I use the 20-day and the 50-day averages as part of your analysis for, I guess, for the stock and the option?
Well, it's more so if I'm just looking at the 20-day moving average, it looks like it's providing a little bit of support. But I think what's more interesting right now is the last 3 days, we've really kind of stayed stagnant in the underlying stock. But the 20-day sometimes can provide support. Twitter's a kind of a crazy stock, though, so it's kind of hard to go look at it technically wise and say, well, gosh, if it hits the 20-day moving average, which I'm highlighting right now on the chart, it's definitely going to bounce. There's many times where it just broke through the 20, the 200, the 50, and then came right back. So in general, there are some stocks, specifically indexes like the S&P 500 index, where the 20-day and the 50-day and the 200-day moving average carry a little bit more weight. But overall, Twitter is just kind of a crazy stock. And that's part of the reason why we picked the strategy that we did. if we're going to speculate on earnings, we want to make sure that we manage that risk going into earnings. And we're just hoping for some good news after earnings if we do the strategy using calls in general.
Yeah, and I think I would just add that the 50-day, 20-day, 200-day, which is another line you have on your chart,
Yeah, that yellow line.
areas that we look at for us non-professional technicians, look at for areas of resistance and support. So that's like the key takeaway, I think, from that. But well put, especially when you're looking at a stock like Twitter, when it doesn't always make much sense. Another question though from Scotty B, Brian, can you set a stop at 47 for the 4-day sold option? How do you do this in Ally?
Can you set a stock? Say that again. I'm sorry.
Stop.
What was it?
Stop.
Oh, a stop at 47. Okay. Can I set a stop at 47? I would set an alert. If that's how I would look at this. I would set an alert, and if that underlying stock got to 47, then I would go and look at the trade, see where it's at, and I would close out that position. So right now it's trading at 45.50, let's call it. I don't know exactly where it's at. Yeah, it is actually 45.50. Good guess. It's at 45.50. So if it goes up 1.5 points, you set an alert, then you go look at the trade and you trade out of it. That's by far the best way in the options world, is to set alerts on stocks and then work trades afterwards. And here's the reason why, is that stop orders, the markets in the option trading place aren't as liquid as they are in stocks. So to say, oh, I'm going to set a stop price, the stock gets to 47, I want to close this at market, because you don't know where the price would be when it gets there. That usually will hurt you in the long run, because you want to kind of work the orders, especially when you're dealing with spreads. So my concept, if I was going to put a stop in, would be to either say, well, if this trade by that first expiration gets to a certain price, maybe 40 or 50 cents higher, you could do that. I'll sell my spread. But I'd rather say, I'm going to set an alert on the stock, and if it gets to 47, then I'm going to look at where the spread is at, and then I'm going to work that order overall. But a great question. Great question.
Yeah, we've got a lot of great questions. Got another one coming in from JHL. She is asking, this is the same idea with your Apple trade. Which one is better? I don't remember your Apple trade, Brian.
Well, they're both meant to be paper trades. Nothing's meant to be a recommendation. But it's the same concept, in that I'll tell you which one is better after they announce earnings. But I don't know which company is going to perform better in earnings. I don't have that quote unquote insider information. So I want to try to manage my risk. And here's where I think long spreads and diagonals are more interesting, is when you have the VIX up around 28%, and that's driving or increasing volatilities across the board on all option contracts. So usually when you're doing Twitter in this instance, and you're selling a 4-day option contract that's 1.5 points out of the money on a $45 stock, you're not going to get 40 cents for that. Normally, that thing would be trading in a normal market pre-pandemic situation, that'd be trading for 15 or 20 cents. The vol just wouldn't be there. So because of the environment that we're in, and that's what stock play of the day is all about, all of our strategies where we talk about advanced option trades, it's all about, well, what strategy applies with the current pricing in the marketplace for options. And this is why I think a strategy like this applies to any stock that may be announcing earnings that you would like to speculate on overall. So I don't know the answer. I guess because first of all, I really just don't know. You tell me who's going to have a better earnings event, and I'll tell you which trade is better overall.
Fair enough, Brian. Well, that's all we've got, all the questions we've got today, Brian. So I think that's going to do it for our show. But I will remind everybody that Brian will be following up on this trade on Friday at noon on the Stock Play of the Day Overtime show. Again, right here, same place, same time, but on Friday. So check in with Brian on that.
All right. And I want to remind you to click subscribe and ring the bell to make sure you get all the alerts. And I'll see you this Friday on the Stock Play of the Day Overtime. Thanks for coming, everyone.